The numbers, please. And here they are, our consumer price index for the month of April. Headline, expected up 0.2 is up 0.3. And do remember, this is a big drop from up 1.2 last month, which was the highest since 2005. If you strip out the all-important food and energy, expected up 0.4, a bit more, up 0.6. The high water mark here is up 0.9, and that was in April of last year, and that went back to 1981. And the money ball, year-over-year headline, up 8.3%. It breaks the streak of 7 higher year-over-years in a row, because in the rearview mirror we have 8.5%, and of course 8.5% takes us back 4 decades. It is a small reprieve, but a reprieve nonetheless. And if we look at core ex-food and energy year over year, same dynamic. It's higher than the 6% expected, Joe. It was up 6.2. 6.5 in the rearview mirror is the highest since 82. So we've definitely moderated just a bit. We see interest rates, well, they have changed rather dramatically. Rates across the board pretty much, and especially the long maturities, have moved higher from down 5 to up 4 or 5, over 3% again on a 10-year. And the reason is quite obvious, is that even though there is moderation, the moderations are small, but we do want to keep a very close eye on several things here. And the first, of course, is that food and energy really did throttle up to the upside. So when we looked at headline, when you stripped out food and energy, the fact that it moved up showed us that those moderated a bit in the headline number. Yesterday, what did we learn? $4.37 a gallon. That's a new high for gas. So some of that feature of energy prices moderating a bit may be something tenuous at best. I'll kick it back to the team to discuss some of these numbers.
Well, we have some really eminent guests, but I got to go to Mike first because the market reaction has been swift. We talked just a few minutes ago, Mike Santoli, about whether it was asymmetric risk. I think it was asymmetric. There was nothing that was going to make people happy, and it was not as much of a respite, I think, as we had hoped. The market immediately sold off.
Yeah, I'm not sure about the counterfactual. If we somehow got a light number, I think the market would have embraced it. The issue is in the previous days, last few days, you actually have seen yields come in. You've seen market implied inflation projections. They're imperfect measures, but you did see people moderating their expectations for what inflation would be down the road. So leaning on that foot, I do think the number comes as an unpleasant surprise. Now, you can still start talking about whether we're past the peak of inflation, but today's number doesn't settle that in any satisfying way. So I think we're stuck with kind of the same market and the same drivers that we thought we did, a couple of weeks ago.